In this lesson, I'm going to go over Vega. So what is Vega? What Vega represents? Vega measures the sensitivity of an options price to changes in the volatility of an underlying asset. It tells you the amount a call or put prices are expected to change when the implied volatility of the underlying asset changes by 1%. Remember, implied volatility represents the market's forecast of the likely movement up or down of the underlying asset's price. High volatility means the price could swing dramatically, while low volatility is a more stable price movement. Vega's value and significance. So positive Vega, both calls and put options that you buy have positive Vega. This means their values increase as volatility increases and decrease as volatility decreases. This is a positive correlation. Now, time to expiration. As a general rule, there are exceptions. Options with a longer time to expiration are more sensitive to changes in volatility. Hence, they have higher Vega values compared to short-term options. Magnitude of Vega. The Vega of an option is usually greater when the option is at the money and decreases as the option moves further in the money or further out of the money. So, quick recap on implied volatility. Besides time value, theta, another component of extrinsic value to options is implied volatility. Implied volatility reflects the market's expectation of the future volatility of the underlying asset. Implied volatility is positively correlated to the price of the option. As implied volatility IV, increases, so does the price of the option. Implied volatility is positively correlated to the price of options again. So it's important to remember that this chart is a simplified representation. In real market scenarios, the relationship between IV and options price is influenced by other factors, such as the underlying asset's price movements, time decay, and interest rates. As implied volatility increases, the value of options will increase, and that's because an increase in implied volatility suggests an increased range of potential movement for the stock or the underlying. Vega measures this sensitivity of an options price to changes in the volatility of the underlying asset. So Vega and days until expiration. Vega falls as the option gets closer to expiration, and you can see how it is with out of the money and at the money and in the money. So what this means is that options further away from expiration are more sensitive to changes in implied volatility and therefore have higher Vega than shorter term options. As a general rule, there are exceptions to this rule, and for learning purposes in this beginner's course, we're going to stick to the traditional Vega calculation models. In days until expiration, you can see that here there's 9 days to expiration, 30 days, 86 days. So this is closer to expiration. You can see the Vega with the same, we're looking at the same strike price. You can see the Vega here is 0.12. As we get further out, it's 0.22, and further out in time, it's 0.38. Vega and Moneyness. So again, looking at the traditional models, you can see the lower Vega because you're closer to expiration and the higher Vega when you're further from expiring, all else being equal. Vega and Moneyness. Vega increases as the underlying moves closer to the specific strike that's at the money. So in other words, Vega is highest for at the money options and falls as options move more in or out of the money. And we'll look at an options chain as an example. When you look at this options chain, you can see at the money here where the Vega number is highest and it drops down even as you get further in the money or further out of the money on the call side. And the same thing here, the Vega is higher, and as you get further out of the money, it drops, or further in the money, the Vega drops. So it's highest at the money there, and you can see that when you look at an options chain. Why Vega is highest at the money? So at the money, options typically exhibit the highest Vega. This is because the uncertainty regarding the final intrinsic value of the option at expiration is greatest when the option strike price is nearest the current price of the underlying asset. A small change in volatility can significantly affect the probability of options expiring in or out of the money, thus having a substantial impact on the price of the option. Why Vega is lower out of the money and in the money. So the deeper in the money the option is, the more likely it will expire in the money. So there's less uncertainty about what's going to happen, so the Vega is lower. Also, the deeper out of the money the option is, the more likely it will expire out of the money. So there's less uncertainty, so therefore the Vega is lower. Vega value versus long-short positions. Long options have a positive Vega and short options have a negative Vega. When you buy an option, the Vega is positive. When you buy an option, you want the premium to increase, or the price of the option to increase. Should implied volatility increase, there will be an increase in the option's premium or value. In essence, when you're long an option, you are long implied volatility. This is why Vega is positive for long or purchased positions. There's a positive correlation. Now, short options, Vega is negative. So if you're selling options, you have negative Vega. When you sell an option, you want the premium to decrease or go down. You want the price of the option to go down. Should implied volatility decrease, there will also be a decrease in the option's premium or the option's price. In essence, when you're short an option, you are short volatility. This is why Vega is negative for short or sold positions. This is a negative correlation to Vega. Practical implications. Trading strategies. Traders might look at Vega to decide which options to buy or sell. For example, if a trader expects volatility to increase, they might buy options with a higher positive Vega to profit from the resulting increase in the option prices. Portfolio hedging. Investors might use Vega to hedge their portfolio against changes in the market volatility. By holding positions with offsetting Vegas, they can potentially protect themselves against adverse movements due to volatility changes. So let's go over a recap. The definition of Vega. Vega measures the sensitivity of an option's prices to changes in the volatility of the underlying asset. It shows how much calls and put prices are expected to change for a 1% change in the implied volatility of the underlying. Vega's value and significance. We discussed the positive correlation of Vega for both calls and put options, the impact of time to expiration on Vega, and how Vega varies based on the moneyness of an option, right? Higher for at the money options and lower for the in the money or out of the money options. Vega in long short positions. It describes how long options have positive Vega and short options have negative Vega, indicating their respective correlations to implied volatility. Vega and days until expiration. We covered that Vega decreases as the option approaches expiration and is higher for options with more days until expiration in general. Vega and moneyness. We illustrated that Vega is highest for at the money options and decreases for in the money or out of the money options due to the uncertainty of the final intrinsic value of the option. I hope you have enjoyed Full Throttle Options Trading Mastery. My new book, it's out, called All Market Trading Profits. And for those who don't know me, my name is Carl Dahm, and I'm also known as the Transparent Trader. My marketing guy, he convinced me to write a book that shares my secret trade details with you. It's the same trade I used to make $597,210 in third-party verified profits from 2019 to 2023. I'm not sure how long I'll keep these secrets in my book, so you might want to grab a copy before I change my mind. Don't miss out. In my book, I reveal the unique trade structure I developed, something you won't find anywhere else. The book isn't AI-generated content. It's real organic material. If you're interested in learning the trade that drives over 70% of my net worth, click the link in the description to get the book and see how I achieved my results. The book is $30 on Amazon right now, and I'm offering a downloadable version for only $5. See that link in the description. My new book, it's out, called All Market Trading Profits. And for those who don't know me, my name is Carl Dahm, and I'm also known as the Transparent Trader. My marketing guy, he convinced me to write a book that shares my secret trade details with you. It's the same trade I used to make $597,210 in third-party verified profits from 2019 to 2023. I'm not sure how long I'll keep these secrets in my book, so you might want to grab a copy before I change my mind. Don't miss out. In my book, I reveal the unique trade structure I developed, something you won't find anywhere else. The book isn't AI-generated content. It's real organic material. If you're interested in learning the trade that drives over 70% of my net worth, click the link in the description to get the book and see how I achieve my results. The book is $30 on Amazon right now, and I'm offering a downloadable version for only $5. See that link in the description.